Hi, I'm Ashley with Campbell. Thanks for investing your time to help your community be a great place to live. Before you watch the video, make sure to click the subscribe button so that we can help you make educated decisions as a board member.
Thank you so much, Ashley. I'm sure I know a lot of you in the audience, so I'm excited to present this today, especially today is April 30th. So everybody this morning in my office sent an email to everybody and said, congratulations, we're on our last day. So it's not that it ends, an audit season ends, but today is the deadline for associations to have their audit completed and made available to the owners. So hopefully you got all of your work to your auditors and got everything put out and it's ready to be released. So today we're going to really highlight through how an audit works. And I am going to give you some examples of what you're required on Florida statutes in regard to income levels. Are you required to have an audit, a review, or a compilation? This is also going to walk through the association's audit, but also how it regards into Florida statutes and also internal controls. A lot of associations, when I first meet them or their new client, and we start talking about internal controls, a lot of board members don't realize how much internal controls are important to an association, also how relevant it is in an audit. When you're getting an audit done, all of this should be taking place throughout your whole entire audit. Whatever firm you're using, there are standards in regards to audits. So there's called generally accepted accounting principles, which we're going to talk about, and GAAS, G-A-A-S, which is generally auditing standards. And we're going to talk about this because as board members, you should understand the audit process. So I really want to make sure we go through anything. Ashley also is on the side that if there's questions that come up that are really important, I do want to make sure that I address them. I'm also going to give you my email address. And if anybody you know knows that I do respond. So if you send me an email, I will get back to you regarding any questions that you have, because I feel that it's very important for board members to get their questions answered. So we're going to start off with some jokes. Auditors are not funny. We're pretty black and white. But how did the auditor propose to his girlfriend? With an engagement letter. So an engagement letter is really an initiation to start the audit. You want to make sure as an association that you're contacting whoever is doing your audit well before year end. It's interesting because the industry is so busy right now with there's not enough auditors to do the work that's out there. And there's many associations that are reaching out too late. They're reaching out in April or they're reaching out in March. It's pretty late in the year to reach out to an auditor to say, can we have this done by April? So I always recommend engagement letters to reach out to an auditor even after tax season to get ready for the next year. Because a lot of auditors, like our firm, we get everybody in line by the end of this tax season for next year. So you want to make sure you're well ahead of that. Why are accountants so calm, composed, and methodical? They have strong internal controls. So we're going to talk about that very strongly through this presentation of why it's so important and what the differences are with having a management company versus being self-managed, and why those controls are so important, and what the difference is when you have a management company versus when you're self-managed to be able to have sometimes stronger controls. Accounting joke. What do you call a trial balance that doesn't balance? A late night. So making sure that the trial balance. Also making sure your budget's balanced. So a budget isn't audited because they're just estimates, but we do look at your budgets to make sure you're in compliance with Florida statutes. Make sure your budget's balanced. I have some associations we go back to and they're like, well, we wanted to make sure we had a surplus. Well, you got to balance the budget. If you want to have a surplus, maybe you budget a little bit more in a repair and maintenance line item and have surplus at year end, but you don't not have the budget balance. Okay, so let's start really into the nitty gritty of what is internal controls in an audit. A lot of the stuff I'm going to discuss today, I'm going to try to put stuff in perspective, give examples, make it more real life than just accounting words, because a lot of people will read this and say, this doesn't make any sense to us. This is something that is accounting language that's over our head. So I'm really going to go through it and try to make it as layman terms as possible for anybody that's on the board, because as we know, you're all volunteers. Sometimes property managers also, their strong point is, construction or management side, and they don't really have the best understanding of the audit side. So it's good to get an understanding today from a layman term. So a process within an organization designed to prevent reasonable assurance. I really, really want to stress reasonable assurance. Why I say that is I'll talk to some new board members. They'll come and they'll interview us to do an audit and they'll say, well, you're looking at everything, right? You're going line by line. You're making sure that everything is booked correctly. Auditors are making sure that it is not materially misstated. So what I mean by that is they're not going through in your regular audits that are certified audits, and all audits are certified. I get that question a lot, but making sure that everything is not materially misstated. So is the depreciation booked? Is your financial statements overall correct? You might have a accounts payable, let's say a bill that was in January, but it didn't get recorded in December and it was for $500. That might not be something that gets booked by the auditor because materiality might be $2,000. So they might say it's under materiality, it's not going to be booked. Make sure you understand that your auditors are not your bookkeepers. They are not the ones that are going and recording all of the invoices, making sure it's recorded in the proper area. It's reasonable assurance. It is not absolute assurance. I really stress this to anybody that's meeting with their auditors. You're not going to be 100% in their audit, and that's not their obligation. They have to make sure that it's just reasonably presented. That information is reliable, accurate, and timely. That's a great thing. We're going to be interviewing board members and saying, when do you get your financial statements? And if they say to us, well, we get our financial statements 3 or 4 months after January, we get in like March or April. That's a problem. As a board member, you should be seeing those financial statements timely. Also asking questions. Is it accurate? Are you looking at those monthly financial statements, making sure that everything's booked in the proper period? What I mean by that, accruals. If you have your utility bills, is it booked in the proper period? Because if you're not looking at financial statements that are accurate, how are they reliable for you to make a good business decision? If they are not on accrual-based financial statements, you're not going to be able to make good business judgments. And what I mean by accrual-based financial statements, a lot of associations will say, we want to be on a cash basis. Cash basis is cash in and out. You're not going to see the accounts receivable. Who owes the association? Very important in associations. Who owes the association any money? Is there bad debt? Do you have a note payable on the books? If you have a note, which you owe the bank money, that's not going to show up on a cash basis. So you want to make sure that they are on true accrual basis. I would say probably a majority of the associations are on a hybrid accrual, meaning that they're booking the accruals, but if one bill comes in super late in the next month, they might book it in that period. That's why I say it's a hybrid accrual. And that's very common in associations. It's not going to be 100% accrual. And we usually recognize that at year end. The most important is at year end, is that truly accrual-based financial statements before you give it to your auditor? I have a lot of times I'll have people email me and say, we have your financials ready January 2nd. I said, that's impossible. That means that nothing is booked. There's no way possible that all of your invoices came in by January 2nd if your year ends December 31st. So make sure you're giving a timely report to your auditor, that you're giving them a reasonable time, maybe around January 25th or January 30th, February 1st, because a lot of those bills will be in, or you can make an estimate to book it on an accrual, which a lot of the management companies do. Also, are you in compliance with all of your policies, procedures, laws, regulations, contracts? The auditors are looking at that. They're going to be asking for your minutes, reading all through your minutes and seeing what happened through the year. As an auditor, we have to get an understanding of your internal controls and also what took place through the entire year. An auditor that doesn't read the minutes, how do they know what happened? What was passed? Were there special assessments? You want to make sure your minutes are as detailed as possible, but not overboard. So some associations will put everything in there. Somebody raised their hand and asked this or this. That's not necessary. You want to make sure anything that was passed and anything that was important are put in that minutes so that auditor can get an understanding of what took place through the entire year. Also, your documents. An auditor is going to get a copy of your documents originally when you hire them, and they're going to read those documents and see what is required. Do you have an audit deadline in there versus what's different from the statute? Special assessments. Is there requirements in your bylaws and documents for a special assessment? Do you need a majority vote? There are many things that are in your documents that you must abide by. So as a board member, if you're new to the association, condo, you have to take a course and make sure that you're getting certified. But also just taking that course, also reading through your documents and bylaws to make sure you understand what that association has to do. And every association is unique. Another thing is staying in touch with your attorneys to make sure that we're making a decision. Should we be asking our attorney first? Yes. Is there something in our bylaws we're not sure about? Reach out to your attorneys. It's very important, and I can't stress it enough from an audit perspective that you rely on your professionals, your management companies that have all the resources, your attorneys, engineers that do your reserve studies. Rely on those. That's what you pay for. It's very important because you are a volunteer board. That assets, including people, are safeguarded. Do you have employees? Are you understanding all the IRS regulations under employees? When you have a management company, those employees are hired by the management company. So there's less risk in the sense that you're not doing payroll tax returns. You're not having to worry about IRS. Did you file them? Did you do the 941s, the W-2s? We have noticed in the last 3 years, so everybody's kind of up on what's going on, the IRS has really come down on the W-2s, the filing of the 941s, filing of your payments when they're recorded, if they're late. We've had numerous notices from the IRS that people haven't filed the W-2s. Then they come back to us and say, what do we do? There's a lot of penalties and interest on that when they're not filed correctly. So you're taking on a lot of responsibility in those self-managed properties to make sure you're regulating with all human resources and IRS guidelines. As an auditor, we're looking at that. And if we see any deficiencies, we're going to put that in an internal control letter. Of the most economical and efficient use of resources, making sure that everything that you have available, you're taking advantage of from an internal control standpoint, seeing that there's regulation safeguards on everything that you have in an association. Overall, established objectives and goals are met. What are the goals of the association? Did you meet those goals at year end? Are you doing everything that you tell us you're doing? Our firm, particularly, any audit we do, we interview the board members, president and treasurer, and the property manager. If we interview them and we ask questions, now we go back to the source documents and say, is this taking place? We're doing walkthroughs saying, is this person telling me there's 2 signatures on checks? I'm going back and checking that to make sure that what they're telling me is actually taking place. Intended to prevent errors or irregularities, identify problems and ensure that corrective action is taking place. And we must evaluate internal controls. One thing I definitely want to highlight to everybody that's here, because it's a misperception that's out there. It's in our engagement letters, but a lot of times it's a misperception when people hear audit. The auditor's goal is not to find fraud. So you'll notice in the engagement letter, it specifically states that. Auditors absolutely are going in and saying, okay, we're looking at stuff. There's definitely auditors that are finding this fraud, but their specific goal is not to say we're coming in here to find fraud. And a lot of times when a board member or property manager will reach out to me and say, I got a call last week. We know we have fraud. And I'll say the question, what do you have proof of? And then they'll say, well, I heard this or I heard that. Hearing something is not proof of fraud. Sometimes it can be mismanagement. So be very careful as anybody that's in the association using the word, I believe that there's fraud going on. Because using that, you're now basically stating that someone has committed fraud and you have no proof of that. I always say until it's proven in a court of law and there's been things done that's proven that's fraud, do not use those words. You can say, I believe there might be misappropriation of funds, and then you might go into where you need a forensic audit. But that would be something down the road once you get into the documentation of where you believe there's fraud. The internal control mystique. So internal control starts with a strong set of policies and procedures. Internal control starts with a strong control environment. I always, from Accounting 101, Audit 101, I always remember my professor saying, tone at the top. And I cannot stress that enough. You as the Board of Governance need to set that tone at the top. The tone at the top is, we are not going to stand for not following procedures. What we put in place must be followed. And they're going to get that. Your property manager, your assistants, anybody that's working for the association will feel that from the board of directors and say, this association takes our internal controls serious. And you want to make sure you start that from the board of directors, not a board of a director coming in and saying, well, we need 2 signatures. Well, today we're just going to do the 1 signature. That is setting a tone in there that you're not really that concerned about the internal controls. That opens up the risk area for associations. And it also opens up the auditor from a risk standpoint. Audits are based on risk now, really looking at the areas that are high risk and focusing on those areas from an audit perspective. A lot of things changed in the audit industry in the last couple of years with really risk-based audits. Internal control, that's why we have internal auditors. Management is the owner of internal controls. Your auditor is not coming in and telling you this is what needs to take place. Yes, they're going to give you recommendations. Absolutely. At the end of the audit, after we've done our evaluation of the internal controls, we're not auditing internal controls, we're evaluating them and giving you recommendations. You'll notice it in the letter, which we'll talk about later on. But you as the association should be setting a list of almost like an accounting manual of your internal controls and making sure you own that as management. And management is the board of directors. Even if you hire a management company, the people that are making the ultimate decisions and setting the policies and procedures are the board of directors. You're the board of governance, the oversight. I'm sure on your insurance policies, which I would talk to your insurance agents, you are the ones responsible for the association, not the management companies. Internal controls cannot ensure success. So in the audit process, you'll hear a lot of times, I'll go to board meetings with unit owners, present the audit, and they say, well, we had an audit done. That means that everything was perfect. Not necessarily. The audit might come out and you might get a clean opinion, but it doesn't mean that the internal controls were an absolute success. First, you want to make sure you're looking at your internal control letter to say, okay, do they have any recommendations? But some of the things that don't ensure success are bad decisions. Did the board of directors make a bad decision? Bad decision is not fraud, meaning maybe they chose a vendor and they didn't realize that that vendor ended up taking a deposit and never finished the work. That's not the board of directors' fault. Maybe they didn't realize that company wasn't what they said they were. Making sure that you're doing background checks or checks on any employees or any contractors that are coming on site. A good thing is making sure that you're documenting that. Do you have a book when those contractors come in and make sure they sign in? It's interesting, in some of the audits we do, we'll ask to see a copy of that login to make sure that vendor actually showed up and was doing the work. We can see the contracts, but was the work actually done on the property when a contract is signed? Poor managers. Sometimes there's not enough experience. A manager will come in to a high-rise condo that has millions of dollars running in there, and they don't understand how the association works. They don't understand condo law. They don't read the documents. So that can be a problem in internal controls. If they come on as a new manager, they didn't read the documents, they get a special assessment pass, never reach out to the attorney, and didn't realize that it requires 51% of the unit owners to pass it. They're the kind of things that cause bad internal controls and problems for the association. Unethical behavior. That's one of the hardest ones probably to stop. Is you might do a background check on someone and do all these things and not realize that person isn't what they say they are. They come in, there's pressures, they end up doing something unethical. It's something that board members should be overseeing, making sure that they're watching and overseeing the manager, the assistant managers, and the employees, what they're doing. I know it's a lot of work as a board member. Absolutely it is. And I give all board members credit. But when you sign on to that, your job is to oversee that association and the funds that are running through there. And it's going to get even a little more complicated in the next couple of years under condo, because there's going to be a lot more money running through those associations due to these new law changes. And it's going to be very, very important for board members to make sure internal controls are in place to protect those assets, that cash that's going to be in there, how it's spent and how it's protected. Collusion. It's one of the hardest things to uncover in an audit, even in a forensic audit. Is there collusion between the president and treasurer, between the president and property manager, and they're in cahoots together? There are two signers and they're the ones doing everything. Very hard to uncover. Kickbacks from vendors. It's another area. I hear it a lot from associations. I had one a few weeks ago that came to me and said, there was definitely kickbacks from a vendor to the property manager. I said, do you have proof of that? No, but the contractor does work on his property. But how do you know that he didn't pay for that? So it's very hard to uncover, and that's where associations sometimes turn into a forensic, and they'll believe that it's going on and they'll hire a forensic auditor. The difference between a forensic and a regular audit, I want to make sure kind of clear that up, because I don't know if it's the TV that everybody talks about forensic today, but that word is going around everywhere. I think in the last 3 months, I probably had 20 calls for a forensic audit. Forensic is even when you start with a regular audit, you're doing a certified audit, and that auditor finds fraud. That can turn into a forensic audit. Or a board member brings proof, documentation of actual fraud that took place, turning into a forensic audit. A forensic audit is absolutely more costly than a regular audit because they are literally going line by line. They're going to be potentially expert witnesses in trial if it goes to trial and it's proven this is fraud. They can subpoena records. They're able to go to the vendors and get information. It's much more detailed. It's much more getting into every transaction versus an audit that is auditing the overall picture of the association. And then override of controls. So that's one of the things that we as auditors really need to understand. Is there ever an override of controls? Let me give you an example. We had an association, we were doing the audit, and they had credit cards, which many associations have credit cards. And on the payment line, it said ACH. We're like, okay, why is there not a check issue? Do they have an automatic withdrawal with the credit card? If they do, are the board members seeing this? Because if they're just every month being withdrawn, who's approving that? So we went into the credit card statements and see that there's no signatures of approval on these credit cards. So we went back and questioned it, and the board members said, well, no, we actually don't see the statements. So we went back, and what was happening was there was an override of controls. So the property manager was telling whoever was cutting the checks that there wasn't enough time between the check and when the credit card got the actual payment. So they were getting late charges. So he was calling in the payments, and every month it was being deducted. What was happening is the board members now were not seeing any of the transactions. So we asked to see copies of them. And what it turns out was there was many items on that credit card statement that were not association expenses. So there was an override of controls. The board members did not know what was going on. When the auditor came in, they questioned it and was able to find the documentation to say these were not authorized charges. So override of controls is something that as an auditor, we're very concerned about. We want to make sure that the controls are being followed that are being told to us. Who's actually responsible for your financial statements and the internal controls? The number one or the top of the chain is your board of directors. They are responsible for the financial statements, the oversight of the organization, and making sure those internal controls are being properly done. Management is second. A lot of times I'll hear from board members when we do the interviews and we do the process and the audit, well, that was the management company. They're the ones responsible for that. They're not. Ultimately, you are, and management follows your decisions. So if you at a board meeting vote for a contractor, your manager now goes and calls the contractor, gets the contract, presents it to the board. They're doing all the everyday tasks, but your board of directors is overseeing that and making the final decisions. I always, always stress anything with contracts or major financial impact on the association, the board of directors should be signing and your attorney should be reviewing it. That's great internal controls. And then your personnel is last. So your employees are not the ones that are going to be making the decisions. The property manager is overseeing your employees, but they're not going to be making the everyday decisions for the association. So responsible for internal controls, board of directors, ultimately responsible, management is primarily responsible, and the independent auditors gain an understanding of internal controls in order to determine the nature, timing, and extent of their audit procedures. What I mean by that, layman's terms. So what does that mean as from an accounting standpoint? Our job is to understand how those internal controls take place through an interview process, through a walkthrough, going to your management company, going on site, talking to the board members, doing the interviews. When you interview them, you're understanding how the process works, who's signing checks, who's reconciling the banks. Then the auditor takes that information now and goes back and says, okay, how am I going to audit this association? They have no controls. They have one signature on a check. One person's reconciling the bank, approving and signing the checks. Auditor, notes go off. High risk, high risk. One person's doing everything. Now the auditor goes back and determines what they need to do in the audit. What is their testing? What are they going to put in the internal control letter? And now they go through all of the records and documentation to get an understanding and to get a feel that everything is being properly done, even though the internal controls are weak. You can have an association that has extremely low internal controls and not a lot of oversight, and nothing's going on and everything's fine. The report for the internal control letter, the AU 265, which I'll talk about later on, might have a lot of comments on there, but the financial statements have a clean opinion and everything's fine. They don't really go hand in hand. If the financial statements were able to get all the documentation and give an opinion, which is all the auditor's own, they can still put a lot of comments in the internal controls. One thing I definitely would like to bring up that's very important, just because there's a lot of things on the internal control letter, the auditors are trying to make your organization better. I would never take that as a negative. I have some board members that'll call us and say, we need this off of the report. I do not want any of the unit owners to see this. This looks bad. It's just helping you as an association do better. So we're actually giving you recommendations to do better as an association. It's not a negative. And then as you put those in place, they go away on the internal control letter and your organization runs better. So always reach out to your auditors, even throughout the year. I always tell my associations, use your auditors as a resource. I had one call me the other day. It was excellent. He's a board member, excellent guy, called me and asked me, they're doing some transition in their association to give them recommendations, which would make their association better for their internal controls. And that's what we did. And I think that really benefits you as board members and even as property managers, calling them and saying, what do other associations do? Because a lot of times, if you're a self-managed community, you're not going to be like a Ford Motor Company that you need an accounts payable, accounts receivable, hire all these people to have segregation of duties. You can still do it with small amount of people, but just making sure there's enough segregation of duties. Control activities, the do's and don'ts of association control activities, approvals. So very important that who's approving the invoices is not the same person that's actually getting the work in. So let's say you have a Home Depot order and somebody orders the Home Depot stuff and it comes in and delivered. Somebody else that actually ordered the stuff should be different than actually signing it in, because that's a segregation of duty. So a Home Depot order comes in, the person that ordered it gives it to, let's say the assistant manager ordered it, the property manager now oversees it, checks it off, and logs it in. Then he approves the invoice. That invoice now goes to the board of directors to approve it, because they're the ultimate ones that sign those checks to say, we received the goods, now we're going to authorize the payment of them. Authorizations, who's authorizing, who has the ability to authorize. Property managers, general managers on site should have the ability to authorize. So they should have a certain threshold. Yes, we need to get supplies. They have the right to authorize it. It comes in, but the signers would be the board of directors, because he's authorizing it. The segregation of duty would be the board of directors signing the checks. Verifications, same thing. Who's verifying that the materials were actually received is different than the person that was ordering it. So like I said, you don't need a lot of people. You can have segregation with smaller amount of people, but making sure there's enough oversight. Reconciliations, very, very important in segregation of duty. You should never have somebody reconciling the bank that has the ability to sign checks, especially if you're using systems like QuickBooks. So auditors have a love-hate relationship with QuickBooks. A lot of small businesses use them. The problem with QuickBooks is you can do a lot of things in there that auditors do not like. So you can delete a check. You can actually write a vendor's name, print it, and then you can change it in the QuickBooks program. So a check could come in that's cash to another vendor. In the QuickBooks, it's made out to somebody else. So there's things that can be manipulated, override of controls that we don't like as auditors. Other programs that are used, you can't do that. You actually have to make a journal entry to change something that's in the system, which that's what we like to see. If there's ever a check that's wrong, you do a journal entry to adjust it, and somebody should sign off on that journal entry that's been done. Segregation of duties. So in associations, it is difficult sometimes if you're not with a management company. A lot of your management companies will have like a supervisor that's a CPA. Under them is the bookkeepers, and then somebody that's reconciling the bank. So there's many levels of oversight in that process in a management company. Whereas when you're self-managed, they have somebody that's on site or they outsource the bookkeeping. But let's say somebody that's on site, that's there doing the bookkeeping. So they're writing the checks, they're reconciling the bank, and then they're the ones that are actually producing the financial statements. So what needs to happen in that situation? Because I'll have board members saying, well, we're not going to pay for 2 bookkeepers. I agree. You have to watch. You also have to say, is the financial benefit worth it in who we pay? So a lot of times associations might outsource the accounting. So they'll have somebody that's not an employee of the association, which I like, because that employee now is not tied to, oh, well, this is my job, I work here. They're an independent company. So they're more likely to go to a board and say, something isn't right. I see a check that was issued wrong. Or they'll be the ones to say, let's make sure the internal controls are in place. If you have somebody that's on payroll, that's fine also, but make sure that that person is now not doing everything. So they're not the ones retrieving the mail, signing it in, doing the reconciliations, cutting the checks, and signing the checks. There has to be segregation. The most important in that process is that the board of directors are the ones approving the invoices and signing the checks, because they're going to see everything they're authorizing and then signing that. Very important. Security of assets. Everybody says, well, associations really don't have assets. Not many, but things like golf carts, gym equipment, office supplies. Is that being overseen that something can't be taken? So we took on a new association a few months ago and we had asked for all their inventory. They have a lot of inventory. They have golf carts, they have pool furniture, gym equipment. Nobody had any schedule of it. So I said, well, how do you know that a golf cart didn't go missing? And they sat back and said, well, we never thought about that. I said, you need to keep an inventory of all of your assets to make sure that things aren't being taken from the association. Now, a lot of associations do not have a lot of that. A lot of times you're not going to see somebody taking a piece of pool furniture and putting it in their car, but there are certain things that can be taken. Sometimes associations will do inventory. They'll keep like filters for the air conditionings for the units. Is there a tracking of that? Make sure that you're overseeing all of that, that things aren't disappearing from the association. Performance reviews. If you have employees for the association, it's very important to do performance reviews. You should be evaluating that person so they don't get complacent in their job. Oh, nobody's overseeing this. Are we doing our job? Nobody's asking. So they get very complacent. You want to make sure you're staying on top of this. I think a lot of times people will say, oh, it's an association. You guys are a business, an actual business that you're running millions of dollars through there. We need to run it like a true business and organization. Controls in place, oversight, and making sure you're securing your assets, and information system controls. So I think in the past, a lot of board members did not take this as serious as a lot of people should. Your computer systems and everything is very important to the association. Passwords, oversight, backup. You want to make sure associations are protected. We've heard through many associations we're doing in the last couple months that some associations have been hacked, where they've had emails sent to board members that were fraudulent. Somebody that hacked their entire systems and shut them down. They had a golf course, they had a restaurant. They had to pay a ransom to get everything back. Make sure that you are talking to your insurance companies. Do you have cyber insurance? Do you have all these type of insurances to protect you as an association? As auditors, we look at that. One of the things in our association, in our firm that we do is make sure we're looking at that insurance policies and you have the protection that what most associations have. Very important that you're talking to your insurance companies now. As you notice, I'm sure you're seeing on the news also, but there's a lot of hacking going on and you are subject to that as an association. There's a lot of information, social security numbers, birth dates that the association keeps on record. And most associations now are paperless. So there's more susceptibility to that you have on file. Key issues for associations. Just going to highlight through this quickly. Segregation of duties. Lack of resources. Associations will say, well, we don't have the money to do that. Well, you want to make sure you build that into your budget so you're able to have good internal controls. Trust the environment. Do you feel that you have a good trust environment with your employees, your board of directors? Do you also have a whistleblower policy that if an employee knows something that's going on, they feel comfortable enough that they could go to somebody to report this? Whistleblower policy is something we put into our internal controls to make sure boards are putting that in place. You want to make sure your employees feel comfortable to be able to do that. Addition of new responsibilities and technical knowledge. Are your employees staying up on all Florida statutes. Are they staying up on their CAMS license to make sure that their license is renewed every year? Taking the courses. Are they up on the new statutes? There's not a lot of new laws in condo. They need to make sure that they are up on that, because if you're not, when an auditor comes in, you're going to get written up in the audit for compliance issues. These audits that are done in the state of Florida are compliance audits. Are you in compliance with your documents and bylaws and Florida statutes? And also in compliance with GAAP. But very important for Florida statutes, because there are penalties if you're not doing things correctly by those. Knowledge of internal controls, compliance with Florida statutes, and then the AU 260 preliminary letter. I want to highlight this, very important. So associations in the last 2 years have gotten these preliminary letters. Some of them they're actually in your engagement letter. So they can be in the engagement letter or they can be a separate letter. Our firm puts it in a separate letter. It's called the AU 260 preliminary letter. When you get it as a property manager or a board member, do not panic. So this year we had associations get it. They read it. Immediately I got phone calls, emails. What is going on? Are you telling us something's happening? No. So it's a preliminary letter, and we are stating to you as the auditors the risk areas. We are telling you these are the area that are high risk, and these are the areas we are going to address in the audit. Then at the end of the audit, you're going to get an AU 260 conclusion letter. And that letter is going to hopefully resolve all those areas and say, we do not believe those areas are risk anymore, and they're off the letter. So it's just a preliminary letter. And when we ask for that, and we send it out with our original open items list, we put in there, this is a preliminary letter to address the risks that are in your association. It's very important to read it, but just make sure that they're preliminary. The ending letter is what's important. And if there is stuff on there, to make sure that you're meeting with your auditors to find out what's going on.
Hey, Nicole, we do have a few questions if you want to answer a few of them.
Absolutely.
Okay, would an asset list be considered an official record document of the association?
So yes, you would definitely, if somebody asked to see that, you would have to make that available, because that is an association record of all of your assets.
And when you refer to management, are you including a management firm and a manager in both of this, or are you referring just to like a management company?
Great question. So if you're self-managed, your property manager would be management. And if you have a management company, they would be management. So anybody that's at that level, property manager or management company, are considered management.
Perfect. And does a condo association nonprofit need to file tax yearly? If this has not been done, how do you start doing this going forward? And is there a penalty for not doing this?
Excellent question, whoever asked that. So it's been interesting. So first thing, let me explain what associations are. So associations in the state of Florida are considered not for-profit, not nonprofit, not for-profit. They are still subject to sales tax in the state of Florida. They are not exempt like a nonprofit. A nonprofit is a charitable organization, a social club. Associations do not fall under that. Under IRS code, they are considered a profit organization. So they either can file the 1120H Homeowners Association tax return, or the 1120, which is a regular corporation, which you would also file an F1120, which is a Florida return. Basically, the 1120H, which a majority of associations file the 1120H, Homeowners Association tax return. You are basically exempt from any monies that come in from special assessments, reserves, maintenance fees. All of that is not taxed. Any income that comes in from outside of that, interest income, laundry income, is subject to tax. The 1120H is taxed at 30%. So this year, which is very interesting, 2023, which we're auditing now, most associations are paying taxes because of the interest they've earned. Regardless if it's an operating or reserve, that income is subject to tax. So I've had associations that have made 100, 150,000 in interest this year, and there's not enough expenses, direct expenses, to offset that. So they are subject to tax. If you have not filed your tax return, first thing, make sure you have it. Second, reach out to a firm that does association work. You can look up online. There's many firms that do that. Contact them. Get a hold of somebody that can get the IRS and get a transcript to see the last time a return was filed. Most likely, there was no taxes due. This is the first year that most associations pay tax. If taxes haven't been due, you can go back and try to file the 1120H. We've done that and we haven't had an issue. You're supposed to elect every year the 1120H when you file the extension or you file the return. You can actually ask for a relief. File the return. If they come back to you and say you're not eligible for the 1120H, you'll do the 1120. Most likely they will accept the 1120H and you move forward. Get the last tax returns done, get them up to date, filed. I haven't seen in the associations we've done where we've done past tax returns, I have not seen an association hit with a penalty or interest for not filing. I'm not saying it can't happen because it is late filing, but the ones we've done, we've asked for a relief and there wasn't any tax due, so there wasn't any really consequences. You just had to get it filed. But if you think you haven't, I would get on it right now, reach out to a firm, get them to file it, and then you can move forward.
Perfect. Perfect. All right. I'll let you keep going. We can answer some more in a little bit.
Sure, of course. Specific internal controls. I wanted to give you some examples. I'm going to try to get a little faster through the presentation. I do talk a lot, so I try to give you as much information as possible. 2 signatures on checks. Right now, a lot of associations are using electronic signatures. Auditors have gotten comfortable with that, with the procedures that are in place. So that is okay too. But I do recommend 2 signatures on checks. That just shows 2 people are overseeing the approvals. No rubber stamps. I actually have not seen that in the last 10 years. Do not have stamps of people's signatures in your office. First of all, if somebody breaks in, they have your signature, and that should never be laying around. Never leave blank checks to sign. Please do not leave your signature on checks and leave 3 weeks out of the country. There's ways to do that electronically versus your signature just laying around. Limits to authority. Who has the ability to sign checks? It should be only certain board members, officers on the association. Supporting documentation. Never ever sign a check without a backup. Even if it says it's coming later. Say, I want to see the backup first before I'm signing a check. Staff members should prepare journal entries, then a supervisor approves them and posts them to the financial system. Great internal controls. Staff member who is in receipt of the money does not account for it. So money should often be accounted by two staff members. I do not recommend accepting cash. Most associations do not. If you do, there's got to be good internal controls for oversight. Most associations I see that do not accept that. Monies that are received over the counter or through the mail are taken to the bank by a courier or a different person other than the person who opened the mail. People say, why would you do that? There's many associations that I had an incident where an association, somebody set up a similar name to the association, a bank account, and checks would come in. They would take one out of the pile, deposit the rest, take one and deposit in their account. They set this up, and then they would do almost like the next check that came in, they posted to that person. So one person was always a month behind, and a month behind, that person's not going to get a late notice. Never noticed that there was always one person behind. We caught it and said, why is this unusual pattern? But that person can set up an account and be taking from the association. 2 staff members should always be involved in wire transfers. Banks are very strict on wire transfers, which is good. Always board members. It should not be staff members approving wire transfers. 1 staff should prepare the timesheet, then a supervisor approves it. People will say, why? Payroll. Payroll is one of the highest areas of fraud, and you'd be very surprised. Overstating their hours, not deducting taxes, their federal income tax, but then filing it, paying it where the association paid the federal tax. They didn't pay it, the association paid the federal tax. Ghost employees, putting somebody on there and they're no longer there. Terminated employees, still paying them, but the bank account is actually going to somebody else that actually still works there. Payroll is a high risk area. And as I stated at the bottom, do not accept cash. We are in a very cashless world right now, which is definitely scary too. But in association world with the internal controls, I recommend not accepting cash. Audit process. Audit process is unique. Although every audit process is unique, the audit process is similar for most engagements and normally consists of 4 stages. Your planning stage, you're going to have the initial, a lot of associations will send us their December. We do a preliminary. We sit down as a team and say, okay, where are the areas we're going to focus on? We're going to highlight what we're going to do. Then we do our field work. After we've made our plan for the audit, we do our field work. That's interviewing, testing, getting the documentation. Then we do our audit report. And then we do a follow-up review. If the board members want to go over the audit to understand what took place and how we came to our conclusion, that's the follow-up review. Client involvement is critical at every stage of the audit process. I will never do an audit, my firm. If I am not allowed to speak to the board members, I will not do an audit. They are involved in the everyday process and they should be able to communicate with us. It's their organization and I need to understand what's going on. And it's concerning as an auditor if a board member doesn't want to do the interview or I have some that say, can you send me the questions ahead of time? I want to make sure I can answer them. This isn't a test. You're doing the everyday operations anyway. We're just asking you questions so we get an understanding. What is the purpose of the financial statements? The object of financial statements is to provide information about the financial position, performance, and changes in the financial position of the association. It is basically telling the end user, which is a bank, is it a unit owner? Is it the association's management company, to understand, do we have enough cash? Are we in a good equity position? Do we have low AR? Did we have a surplus last year? Do we need to pass a special assessment? Are we deficit in our reserves? It's the overall financial position of the association. Are you healthy or do you need to do more? And it helps in your budget process where you're at financially. Also for prospective investors or lenders. Right now, after the whole Surfside collapse, tragic Surfside collapse, associations, anybody that's coming in and buying into a community is asking for these audits. They want to see the financial stability of the association. It is very important to have a year end, especially from an independent person, an auditor, a CPA firm. They want to make sure somebody independently has evaluated that and issued the report. Why the need for financial statements? The first is Florida statutes requires it. 718 condo, 719 cooperative, and 720 homeowners association all require, based on thresholds, the audit. Anything over $500,000 requires an audit in an association, unless the membership voted to lessen the audit to do a review or a compilation. But you must have one report done. Many people say we voted to do nothing. That's not allowed. You must do one of those reports. If you have a review, the income is from $300,000 to $500,000, and a compilation is $150,000 to $300,000. Anything under $150,000 is a cash disbursements, cash receipts report. They're one of the, I would say, the worst reports out there. It's a cash position. Most associations that require that step up and do a compilation. And they do that because it's more beneficial to the association for the overall financial position. What are the differences? The differences is an audit is you are getting a test work. That means, in layman's terms, we are actually going in and verifying. We are testing your invoices. We are looking at your minutes. We're going through your bank statements. We are testing. We are doing a test work. We're actually sampling and going through and being able to issue an opinion after we do that. A review is basically analytical procedures. We're going in and saying, okay, let's look at the repairs and maintenance. Why is that over or under? Why was it different from last year? Let me pull up the GL. Maybe I'll do a little looking through some invoices, but it's not a test work. And a compilation is basically taking the association's financials, putting it on our letterhead, making sure everything looks good, foots, but it's not doing any really type of analytical procedures, no testing. We're not going through invoices and posting any of that. Minimal adjusting entries from a financial standpoint from our firm. Benefits. An audit is giving that assurance to associations that overall, we think that the financial statements are not materially misstated. We're adjusting certain line items to make sure that they're in compliance and that they're financial reported correctly. The reports are not much different. So if you looked at a compilation report, audit, and review, there's still footnotes, there's still an income statement, balance sheet, cash flow statement. They look similar. The only difference is the audit report. The audit report is giving you an opinion. And one thing I want to make sure I'm very clear on is that associations, the only thing the auditor owns is the opinion. All the footnotes and all of the financial statements are owned by the board of directors. And that's why you sign off at the end of the audit report, because you are taking ownership of that. The auditor only owns the opinion. What are the requirements for Florida Statute 718 to have an audit review or compilation? I just highlighted that for you. If anybody wants those listed out, you can email me. I'll give you those, what requires an audit review or compilation. Remember, if your documents require an audit, talk to your attorney. That might override the actual statutes. That's something that you need to ask your attorneys. That's a legal question. What is GAAP? Generally accepted accounting principles. What is GAS? Generally auditing standards. Make sure the auditors, when you interview an auditor, that you ask them that. It's very important. Review of the audit process. First, you're going to get an understanding of the internal controls. You're going to determine the plan. What am I going to do in this audit? Then you're going to perform the test of controls. You're going to reassess the control risk and modify it if you see something comes up. If a board member gives me a different answer, I'm going to go back and test extra because it doesn't match what he told me. Perform substantive tests and complete the audit, and then form an opinion and issue the report. So people will say to me, that should be an easy process. It only should take a couple days. No, it takes a lot of time to go through that, document it, get all the information, and then get all the open items. Types of opinions that the auditors can issue. An unmodified opinion. That's the one that associations want to get. It is telling you that there's not any material adjustments. The financial statements that were given to you are in good order, and we feel confident that the association has not materially misstated what they presented to us. There's things that we can add to that. For example, there can be an emphasis of matter. If something in the association we feel that we need to highlight in that opinion that's concerning to the association. Questions going concern. I haven't seen any of them that we've done. I've heard from some firms that they've seen that. A going concern is this association going to basically go into receivership? I find that hard in associations because the board has the right to special assess. So I haven't seen that opinion out there. Some have said they've seen it. Conditions required for an unmodified report. The financial statements must be presented in accordance with GAAP and adequate disclosure. So everything in your footnotes needs to be disclosed. Anything on your balance sheet, income statement, are there lawsuits, your FDIC insurance must be disclosed, all of this. And one thing you're signing off at the end as a board member is the management rep letter, making sure that you have told us everything. Have you ever misrepresented something to us? You're signing that letter saying you haven't. It's very important. If board members will not sign that management rep letter, you actually get a disclaimer of opinion because it's a scope limitation. The next paragraph says the audit was performed in accordance with GAS and there were no significant scope limitations. That means anything I asked for, I was given. If it's material and you cannot provide it to me, my opinion would change. Very important, everything the auditor asks for, you give. Types of opinions, a modified opinion. Is there a departure from GAAP? If there was and it's not material, you might get a modified opinion. For example, some associations choose to capitalize nothing. They decide we're going to capitalize no assets, even though only tangible assets get capitalized, it's still a departure from GAAP. So that could be a modified opinion. Scope limitations. Are they material or not material? If they're not material, it might be a modified opinion. Adverse opinions. I have never issued one, and I hopefully never will have to. I'd probably disengage before that, but that's a very material departure from GAAP. That is something that is completely misleading that's in the financial statement that the auditors not feel comfortable putting it out. And a disclaimer of opinion is basically we are not issuing an opinion on the financials. It's either a major scope limitation. You're not providing information to us that is important in the disclosure. If it's important in the disclosure and you don't put it in, it's misleading to the end user. For example, is there a major litigation going on that you're not disclosing in there? That's a problem because the end user needs to be aware of that. Significant uncertainties, a lack of auditor independence. So one thing in an audit position, when they come in, they have to be independent. They cannot have any affiliation with the association. They couldn't live there. They couldn't be on the board of directors because they're basically auditing themselves. So they must be independent when they do an audit. This is an example of the audit report. So many of you probably have seen it's changed in the last couple of years. The audit report used to be 1 page, then it became 1.5 pages. Now it's almost 2 full pages. So you really want to look at this and you're going to see the actual second highlighted down, the basis of opinion. That's where your opinion is. It's basically telling you that we're comfortable with the financial statements and we're issuing a clean opinion. And then this on the end of the report is what's been added in last years. It's basically going through and telling you about accepted auditing standards, and it's listing all of that out. It's basically explaining to you what we've done, what the auditors are responsible for, and making sure you understand it. I think one of the most important things in an audit when you get it is you read it. I cannot stress that enough. I'll issue an audit report, and then 2 minutes later, the approval comes back in the manager up letter, and they're like, we're good. You can send it out. There might be stuff in there that you told us that we put in the footnotes that isn't correct, or maybe something's off. Auditors are not perfect. There are things you need to read in there and make sure it's being told right. For example, sometimes in the minutes, there will be minutes that weren't sent to us. And you said there wasn't a meeting, and it was the meeting to waive the reserves. So in the audit report, it says you might not be in compliance with Florida statutes. Well, maybe there was a minute you never sent to us, and now it's saying you're not in compliance. It's something very important to read the audit to make sure that everything is correct in there. What is a balance sheet? A balance sheet is a statement of a financial position at a point in time. At December 31st, what is your cash position? What is your accounts receivable position? Your fund balance, your liabilities at a point in time. So like, for example, your cash position at 12/31 might be $1 million. By January 2nd, you might be down to 500,000, depending on the invoices paid out. So it's a point in time of your assets, liabilities, and your fund balance. Most important part of your financial statement, the financial stability of your association. What are your current assets, cash, accounts receivable? That's the main area of what associations have. Deposits might be on there too, prepaid expenses, depreciation. Not every association has depreciation. Liabilities, do you have a note payable out there? That's on there. They make sure they verify that with the bank, the ending balance. Also now something new in the liability section is your contract liabilities or your deferred revenue. The new topic 606, the revenue change in 2019, you're going to see a large number under contract liabilities on your reserves. The reserves change in the sense that you're basically deferring all your revenue till it's spent. So it's under liabilities because it's actually money collected for future projects that you're going to recognize as revenue in the future. It's the same thing as almost a special assessment. You defer it till it's actually spent. Your equity position, that's your surpluses and deficits over time is what your equity is. If you're in a positive equity position, that means you've had more surpluses and deficits since inception of the association. This is your balance sheet. I'm trying to we only have a few minutes left, so I have a long presentation, but this is what your liabilities is, and then your fund balance. Fund balance is the financial position of the association. A lot of people go right to fund balance. It's like equity that's in regular corporations. What is an income statement? It's your profit and loss. Revenues, less expenses. How do we end the year? And that's on accrual base. That means that there will be expenses that you may have paid in January and February, but they're accrued for at December because that's when the bill was actually, the service was performed in that year. And you want to make sure that's important. Cash flow is just your net cash from beginning of the year to end of the year and what the net change was in your cash position. What are footnote disclosures? I'm going to go through this quick for you. Footnote disclosures, I think, are the most important part of a financial. You are highlighting through the aspects of the financials and disclosing it. So you're basically going through and saying, what are key important financial points that people need to read about? Special assessments, FDIC insurance, reserves, very important a part of footnote disclosures. Litigation, is there litigation? What is your insurance deductible? These are the kind of things that are very important. Concentration of credit risk. Are you under the FDIC? If you're not, it's going to be disclosed. Income taxes. Did you have an income tax liability? Do we need to disclose that? What are you filing, the 1120H or the 1120? Litigation, as I spoke about. Special assessments, really important part of an association. Also, if you had a special assessment after year end, it's going into your subsequent events. So anybody reading that can say, oh, they had a special assessment after year end. That must be included. So make sure you're reaching out to your auditors if you had one, the fact that you need to disclose that. Future major repairs and replacements is required by Florida statutes. It's a supplemental report that's included in the audit. It is required, and there's certain language that has to be in there. The auditor's communication with charge of governance, this is the letter I talked about. This is the conclusion letter that you want to make sure you look at. The initial one you looked at, look at the conclusion to make sure it's different. And then the AU 265 letter is your internal control letter. That gives you all the comments that the auditor found and said, this is the things that you need to work on. I got through that. So I'm happy if we have questions that are there that maybe I could answer or.
Yeah, of course. And yes, you did get through that. All right, I am going to launch the poll. That way, if anybody does have to leave, we would really appreciate you, giving us your feedback on how we did today. And just real quick, I will be emailing out the presentation, the recording for this, Nicole's contact information after via email. So you will get that. We did have some questions that were very specific to an association. So if that's the case, maybe if you want to email Nicole separately,
Yes.
we're not going to answer those right now. Just a few that we can run through. Nicole, how often is the association supposed to have an audit?
Yeah, so if their income is over 500, it needs to be done every year unless the membership votes to waive it for a lesser service.
Okay, and when should the audit begin for the previous year?
Sure. So you should you should have your engagement letter signed before year end, and you should reach out to your auditor by February 1st so they can get the information and start the audit process by February.
All right, let's see here. Let me get a few others here.
Good questions.
Let's see here. One person asked, are CAMs included in this decision? So now I'm not sure which decision they were. Do you remember?
Yeah, I'm not sure.
Yeah.
Yeah.
We need a little more clarification on that. Should an HOA file an 1120H or a 990?
Good question. 990s are not filed by associations. 990s are nonprofits. Every association either files the 1120H or the 1120.
Okay. And then somebody else just asked, is it 1120H or 1128 IRS filing? But you just said it's 1120H.
1120H or 1120. It depends on what you actually qualify for.
All right. Let's see here. What is a direct expense offset to bank interest on reserve bank account?
Great question. So the only direct expense is bank fees, which most associations don't have a lot. Then the auditor can look at allocated. So what we do is we take a percentage of administrative fees, your management fees, your insurance, and we take maybe 4% of that and offset to try to reduce the interest that's taxable.
All right, it looks like there was clarification. We were speaking in terms of boards of directors and management when she referred to CAMs.
Okay, and she's asking who's responsible?
Yeah, we were speaking in terms of board of directors and management.
Okay, so board of directors is ultimately responsible for everything. The managers take direction from the board of directors and they do the everyday tasks of the association.
Yeah. Let's see here. Can you confirm what financials are considered official records of the association and must be given to a homeowner upon request?
Sure. So you definitely want to reach out to your attorneys too on this, but from an accounting perspective, not legal. But I always tell my associations, like your monthly financials that you get as a board of directors, that would be made, if someone asked for it, you would make that available. But if you have bank statements in there, you want to make sure that you are not showing the account numbers. So you'd want to make sure that's taken off. And if you have an accounting program, like a QuickBooks program, you are not obligated to let them have a copy of your actual software. So you can have printouts. So you can print out, I'd also be talking to your attorneys. Are you obligated to give an accounts receivable report with people's names on it? That I don't know. That would be definitely a question for legal. But if you get a monthly financial, things like that, like your balance sheet, income statement, any of your reconciliations, that definitely would be made available to an owner.
What is GAAP?
Sure. Generally accepted accounting principles.
Okay. Perfect. Does the signing of the engagement letter by the board need to be voted on by the board at a meeting?
No, it is not required. What I do recommend is if you've interviewed 3 and you make a decision, I would bring it up at a board meeting so it's documented, but the president or treasurer can sign that, and it's not required that it has to be voted on at a board meeting, unless your documents state different.
All right, let's see here. What does 718 say about audits that are not provided to owners by the end of April? What recourse would owners have when an audit isn't delivered in compliance with 718?
So obviously April 30th is the deadline, but many associations don't get engagement letter signed or the work to the auditor, so they can't have it done. there's no longer requirement to turn that audit into the state. The state does not review any of the audits. Unless a unit owner turns you in, there's really no recourse, meaning the state's not coming after you. What I always say is, I mean, that unit owner ends up paying it too. If you get fined, they pay that. So what I would be advising the unit owners, it's coming, we got the work in, you got extended by the IRS, and once all the work is, they'll issue the draft. So there's really no recourse unless somebody turns you in.
All right, and let's do one last one here. Actually, we'll do two more. What should a board do if they are unable to sign the rep letter, specifically making representations about internal controls at the management company?
So in your management rep letter, if you're saying you're not comfortable, that's a problem too. So you should be talking to your auditor to resolve those issues, why you're concerned. Because if you can't sign that rep letter to represent to the auditor, they can't issue an opinion. And I would not want a disclaimer because you're concerned about internal controls. What I would be doing as a board member, reaching out to my auditor, having a conversation and saying, these are my concerns. Let the auditor now do more testing on it and come back to you and say, this is why we're comfortable, or this is why we're not. Let them put it in the internal control letter, and then maybe the management company can make a change based on what the auditor represents.
All right, let's do one last one. This is kind of interesting. Our HOA turned over at the end of February. We're still waiting for the turnover audit from the developer. What recourse do we have?
Okay, great question. So first of all, it's due 90 days after turnover. So what I'd be doing is reaching out to the developer, have your attorneys maybe reach out and say, what is the time frame of getting this? A lot of turnovers do go over the 90 days. And the reason why is it's getting information. A lot of times the turnover is going from inception to turnover, and the amount of work that the turnover auditor has to do is extensive. And a lot of times work is missing. So it's taking a long time. What I would ask is, ask to find what the auditor anticipates getting it. And if they're telling you it might be a little delayed, it's worth a delay in the sense that you're getting good financials. That turnover is very important to your 558 or whatever you're doing. So I would give them a little more time if needed, but it is due 90 days. I would get a time frame from them and then talk to your attorneys about what the recourse is. Because if you're an HOA, I don't know if the state gets involved, where condo is different. Condo does have more regulation on that.
Thanks for watching. For more great educational content, click the subscribe button now.